And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And welcome to the show this morning. Of course, it's the second best day of the week as we knock out the first half of June, right? I mean, so, almost head to the end of this quarter. Of course, June being the last month, third quarter, which means earnings season right around the corner again. Also, blackout period for stock buybacks starts today. So all these buybacks that have been kind of supporting the markets here really since April have run their course momentarily. Now, this doesn't all happen at once. It's not going to be like tomorrow the market just falls off the cliff because buybacks stop. But we're starting to enter that blackout period, which runs about 30 days or so before companies start reporting their earnings. And so as earnings reports start to come, the blackout window is going to accelerate. So by the beginning of July, most companies will be in blackout period for buyback. So again, it's not the end of the world. It just simply means that you're removing one of the supports, one of the buyers from the markets. And in the second quarter, we've had a very, very sharp increase in buybacks. If we look at buybacks over a 4-week period, it's been a very sharp increase in buybacks over the last 4 weeks. Of course, and that kind of corresponds with this rally we've had in the market since really kind of that April low. May and June have seen that very sharp increase in buybacks, and that's corresponded to, of course, a market rising sharply. Of course, yesterday, and we're going to get into this day, Michael Liebowitz in the green room right now, getting his makeup on and getting his morning coffee. So once we get to the next segment, we'll talk about the Fed meeting yesterday, the FOMC, inflation. We've got all that coming up for you this morning. But I wanted to spend a few minutes today just looking at a couple of other pieces of data points that, and we'll take a look. We're going to kind of take a look at some of the various markets this morning as well when we do our Before the Bell segment. But if again, economic data continues to weaken here. And it's interesting because Jerome Powell did make a statement yesterday, which I thought was very fascinating. He says, we need to see more good data before we can cut rates. And this is a very alternate universe that we have now moved into, right? Because good data used to be strong employment, strong economic growth, which would lead to higher inflation. And that's okay. If you've got strong employment growth and rising wages, inflation's not a problem, right? Because you can afford it. And so if you have strong economic growth, strong employment, rising wages, inflation should be higher, right? And the Fed should not be cutting rates. They should be going, hey, this is good, right? We want 300,000 jobs a month being created. We want higher inflation because that means the economy is really firing off on all cylinders. We're gonna keep rates elevated here just to kind of keep things in balance. But there would be no reason to cut rates in an environment where economic growth was a good thing. But see, interestingly enough, we live in this alternate universe now because of the debt, not just the government debt. See, when you talk about debt, everybody immediately assumes you're talking about the government debt. No, we're talking about household debt, corporate debt, financial debt, all that debt that's out there, right? Can't sustain higher rates. Housing can't really sustain higher rates for very long. And so what now has become good news, we need more good data. We need weaker employment, right? We need rising unemployment, weaker inflation so we can cut rates. Well, if you have weaker inflation, that means you've got slower economic growth and rising unemployment. How is that actually good for the economy? It's great for the stock market, right? Market's hit an all-time high yesterday. But again, we just kind of live in this new bizarro world where the days of when I was growing up, economic growth was a wanted thing. Prior to about 1990, we grew the economy regularly at 4 and 5%, and now we're just hoping to get to 2% growth on a steady basis without slipping into a recession. So that's just kind of where we are right now. Okay, let's talk a little bit about markets. Here's what you need to know before the bell this morning. So yesterday, the S&P 500 set a new all-time high. Nice pop up yesterday morning after that inflation report. Stocks opened strongly higher. Finished the day up about 84 bips, almost a percentage yesterday. Did kind of hit we were up over 1% during the day, kind of sold off a little bit going into the close. Not surprising. It's been a very, very strong run here. But as we did talk about yesterday morning, we said, hey, if we do get a cooler print, we could really see the market kind of pop up. That's what happened yesterday. And ironically, if you take a look at the heat map, it was pretty much just Apple, Microsoft, and Nvidia driving the markets yesterday, intraday. So most of the gains coming from the Mag 7. Once again, Tesla also had a very nice day yesterday. But so that was really kind of lifting the markets. And again, this continues to be a very, very lopsided market. So this is the S&P. Importantly, relative strength back to very, very high levels here. So, every time typically we get to these more elevated levels of relative strength, you typically have some sort of correction or cooling off period. And that goes back kind of through history. It doesn't mean that it happens just right away, but it does suggest that risk reward is getting a little bit imbalanced. And the deviation from the 50-day moving average is getting pretty extreme again. So, as we talked about back in February and March, we said, hey, markets are deviating from the 50. You're going to get a correction. It took a couple of months, but you finally got one. And that's probably going to be the same case here. Markets can kind of gyrate here around a little bit heading into the end of the month. But once we get into earnings season, may see a little bit of weakness come into the markets. But this is the S&P. Once you start getting outside the S&P, and really the NASDAQ kind of goes hand in hand with that, the equal weight index continues to really kind of underperform the overall market. The gap in performance is getting wider between the S&P, which is market cap weighted, and the S&P equal weight index, which all those tech stocks have much lower weightings. And again, if you have less weighting of those Magnificent Seven, you're going to have underperformance. And we see that very clearly with the equal weight index. Gets even more magnified if we drop down into the small cap, mid cap space. This is IWM, which is the Russell 2000. 40% of that index is non-profitable companies. So again, there's a very big difference between what's happening in the S&P and what's happening really kind of in the rest of the world in terms of equities. And once you get into smaller mid caps, that small mid cap space, they are much more sensitive to economic data. So if economic data is slowing down, that's going to further impair their profitability. Most importantly, since 40% don't have profits, they rely on debt to a big degree. And more importantly, as you start to look at the small mid-cap space, those become much more challenging in an environment where the profitability of the liquidity of consumers is becoming much more constrained. But again, despite a record rally in the S&P 500, Russell 2000 index is still below its peak of 2022. Sorry, if you've been invested in IWM since 2022, you're still underwater over that period. We see the same thing in the strict small cap space. This is the S&P 600, which is S&P small caps. Again, just really big underperformance relative to the S&P, and this is just a function of the breadth that we keep talking about over and over again. The Mag 7's driving the stock market. We got narrow breadth. This is the Magnificent 7 make up 30% of the overall index. 38% of the index is made up by the top 10 stocks. Because of that, that's why you're seeing the lag in the S&P as well, and the S&P small caps as well as IWM. And more importantly, these companies don't do buybacks to any great degree, not to the magnitude of Nvidia or Apple or these other companies that are doing massive multi-billion-dollar buybacks. These companies don't have the capital for it, so they can't boost their shares by doing buybacks. So that's what you need to know before the bell this morning. When we come back from the break, we'll pick up with Michael Leibowitz. We're going to talk all about the Fed this morning. So we'll get into Fed, inflation, FOMC, all that coming up right after the break. Don't go away.
Now for something.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
It's back. Get ready for our next live chat edition of Candid Coffee with Richard Rosso and John Penn, Saturday, June 29th. Anything you want to know, we'll find the answer.
What's going to happen to interest rates?
Should I put all my money in gold?
Has Lance been working out?
Register now and submit your probing questions for John and Rich at realinvestmentadvice.com.
How far will Nvidia go?
What about Social Security?
Who does Mike Leibowitz's hair?
The live chat edition of Candid Coffee with Rosso and Penn. Register at realinvestmentadvice.com. Realinvestmentadvice.com.
Are those your pajamas?
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show this morning. Last night I had to chuckle. My Brent, you have a dog, right? You have a Roomba? You have a Roomba. Yeah, Roombas are great. So I have 2 dogs. You know, they shed a little bit, right? They don't shed a lot. So we have this Roomba that we've had, and it roams around the house and, you know, cleans up dog hair. Anyway, last night my wife comes home and she says, honey, I said, what, babe? Oh, whenever she starts out with honey, I know it's about to cost me money. And she goes, honey, we need a new Roomba. And I'm like, why do we need a new Roomba? She goes, well, the thing's like 80 years old. It has apparently lost its mind. It just kind of roams around the house aimlessly. And every now and then it just kind of poops all its stuff out on the floor. And I had to chuckle. And I was like, okay, honey, we can get you a new Roomba. And so after she went to bed last night, I got her phone and I reprogrammed the name of the Roomba to President Biden. So I'm waiting for her to log into her phone today. So we'll see. I'm probably going to get in trouble with this one with her, but I just couldn't resist myself last night. So when she said it was 80 years old, running around the house aimlessly, I was like, what a better name. Anyway. All right. Got a lot of stuff to get into this morning on the show. Michael Leawood's joining me. So Mike, just give us the quick rundown yesterday. I think probably by now with all the major headlines, I think most people get the gist of what happened at the FOMC meeting yesterday. But what was your takeaway?
Really, nothing happened. I think the Fed acknowledged that. It's funny, they in their statement, they made literally one change from the prior statement. And in the prior statement, they said that there was a lack of progress towards meeting the inflation goal. In this statement, they said there's modest further progress. So the trajectory is back down towards lower rates in the Fed, lower inflation in the Fed's mind, where it was flatlining prior to, I guess, the CPI report, right? Because that's what they're basing that off of. But then at the same time, they raised their core PCE inflation forecast from 2.6 to 2.8 by the end of the year. And they changed their Fed funds rate outlook to only one cut.
Well, yeah, hold that real quick too, because yes, they did raise that core inflation. Look, they didn't raise the rate of inflation. In other words, saying we think inflation will be higher. They just said that core is not going to come down to their target as fast. So they're just raising their lower end of their target. And again, there was a lot of misreads on that. It's like, oh, they're raising their inflation target. No, they're just saying that it'll reach they had expected core to reach 2.6, but we're currently at 3.4. So by the end of this year, if you just kind of look at a 0.2% decline over the rest of this year, whatever it is, you're going to be at 2.6 for 2.8 versus 2.6. So they're not raising their inflation target for this year. They're just saying that it's likely going to take longer to get to where they wanted it to be than what they thought previously.
Right. And he was pretty humble. So when Powell did his press conference, he was pretty humble. And someone asked directly, do you have confidence in your forecast? He said, no. Yeah. He said, we're taking it as data comes. So he was very, this was kind of a new level of humbleness from Powell. Mm-hmm. And I think what he's trying to say is the economy has normalized. And he said that in a number of different ways. He specifically said the labor market is back to normal based on the data they're seeing. He also said, this was interesting, we know the labor market is overstated. Right. This is something we've been talking about for a long time, that the numbers that the BLS puts out just don't jive with any other data, including numbers that they put out themselves. Mm-hmm.
And that's also very interesting because the Federal Reserve never says employment is overstated. They always say it's understated. And particularly it's interesting he'd make that statement going into an election cycle.
Right, because I think, they're still scared about inflation, but they're scared of the other side too, that they know rates are very restrictive compared to history. Right. They're too high. And he knows that. And he knows that they are putting pressure on the economy. But what he's trying to tell you is that the economy has gone from a high level. It's now very close to where it should be. But what he doesn't know is it just going to start staying at that kind of normal level, or is it just a trajectory lower and we just happen to be at normal right now, and it's going to keep going? And if the answer is that we're just passing through normal on our way to below normal, he has to cut rates much sooner than I think people think. And if we are normal, he can take his own sweet time to cut rates. Mm-hmm. And he's telling you he doesn't know.
Right.
Yeah,
Well, and
there-
real quick, it's a good point that you're bringing up, and when you talk about a normal economy, I think you've got to put that into a little bit of context, because when you say normalized for the Federal Reserve is 2% growth economically. Now, and that's ironic, as I was saying earlier in the show today. We used to talk about a strong economy being at 5 and 6% growth. If you were at 2% growth, that was considered pre-recessionary. Since the turn of the century, 2% growth has been a target. It's like, man, if we can just get to 2% growth, we're doing good, because 2% economic growth basically absorbs your population growth. So if you have population growth at 2% economic growth, you're putting all those people to work. You're not creating excess employment. You're not growing the economy. You're just stabilizing. But that's now become the new normal. And, here we are at 1.3% in the first quarter, where, we were at 4.8 in the third quarter of last year, 3.6 in the second, in the fourth quarter, 1.3 in the first quarter. You put all those together, we're running closer to about 2.4% growth on a real basis. And so that's so when you're talking about normalized, what the Fed's hoping is that we can come down to 2% growth, which would be 2% inflation, which would be 2%, kind of overall environment. That would be ideal for them. But your point is we just may be at that 2% mark, but going lower. And that's what the Fed doesn't know yet.
Right. And he made mention of that numerous times as well, that their rates are very restrictive. So, can the Fed cut rates with inflation where it's at? And I think they would love to. Right. I think they are scared that they're causing a lot of damage beneath the surface that is slowly working its way up. And as the economy normalizes, that damage becomes more and more evident. But it really struck me was kind of how humble he was with their forecast. And one thing he said about the inflation forecast was they made those forecasts prior to seeing the CPI data. And something to the effect that may have changed had they had the CPI data when they made those forecasts. So the point in kind of sharing that is that this, as he says all the time, they're data dependent. Their forecasts are changing constantly. So whether it's 2.6 or 2.8 inflation or 2.2 or 2.4, they're guesses. Just like we're all guessing. The data has been so screwy since the pandemic. And, whether it's politically motivated or just because there are so many new factors impacting all this data, who knows what's going on? And being an election year doesn't help because it certainly raises suspicions. But at the end of the day, that's all they have is data that they acknowledge is not great data. It will be great data when they revise it,
right.
In 2 years from now. They'll know exactly what happened.
Right.
But no one has the data on what the economy is really doing. We all have hunches and we all have guesses, and the Fed's telling you that that's what they have as well.
It's a great point, because when you talk about the data, and again, whether it's employment or whether it's inflation, whatever it is, we don't have a good measure of real-time data in a lot of cases. And a lot of these, like we talked about before, like with the employment data, it's surveys, right? You're calling people up and saying, okay, are you working or not? And you're calling a small sample of people and then trying to extrapolate that across the population. So a lot of this is just guesses that,
right.
You're making these assumptions on. And I thought it was interesting because, yesterday, the market, to his point, hey, we're just, we're revising our forecast as the data's coming in, and yet the market yesterday kind of took the report that their projections, they're only going to cut rates once this year, and that may or may not be the case, but as you and I have talked about, they're probably not going to cut rates before the election, which only gives them 2 meetings, after the election. A lot can happen between now and then.
Right. Yeah, and that's what he's telling you. I mean, I think there's a possibility, albeit small, they could cut at the July meeting. Mm-hmm. And I think there's a possibility, probably not as small, that they don't cut at all this year. There's data changes, the economy's changing, and it's rapid, and they don't know. And he wants you to know that they don't know when they're going to cut. But at the end of the day, I think what he's also trying to tell you is whether we cut in July or whether we cut in November, and he made a statement to this effect, doesn't really matter. It's the long-term trend of cutting and how much we cut and how the economy responds. So I think he's trying to get the markets off the Fed's tail a little bit. It's like just give us a little space.
Right.
It doesn't matter whether we cut in July or September or December. In the grand scheme of things, it's going to have a minimal effect.
Well, that's right. And again, as we talked about before, this market is just knee-jerk reacting to every inflation report, every employment report, and not because of the data, right? It's just, what does that mean for the Fed cutting rates? And to your point, the Fed just needs to leave us alone, give us a little bit of room here to operate, and we'll do what we need to get done. All right, quick break. We'll come back. We'll talk. Let's flip this over to the other side. Of course, what does this mean to the markets? We'll talk about the bond market. We'll talk about the stock market. All that's coming up right after the break. Don't go away.
Can't you see that love is everywhere? Step into the confusion. Can't you hear the sound that's in the air? It's rock and roll. 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 It's rock and roll.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
It's back. Get ready for our next live chat edition of Candid Coffee with Richard Rosso and John Penn, Saturday, June 29th. Anything you want to know, we'll find the answer.
What's going to happen to interest rates?
Should I put all my money in gold?
Has Lance been working out?
Register now and submit your probing questions for John and Rich at realinvestmentadvice.com.
How far will Nvidia go?
What about Social Security?
Who does Mike Leibowitz's hair?
The live chat edition of Candid Coffee with Rosso and Penn. Register at realinvestmentadvice.com. Realinvestmentadvice.com.
Are those your pajamas?
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Danny, inflation's getting bad. You remember back in the day when strippers used to have names like Crystal and Diamond after something really expensive?
No.
The Real Investment Show podcast.
Well, now you go to the men's club, it's like, welcome to the stage, gas and eggs. So, you just know stuff's getting bad, man. Inflation.
Same show, your schedule.
Where'd you get this from, Lance? Is this?
I was thinking about this last night. I was like,
at realinvestmentadvice.com.
Because it's on all cash business.
Yeah.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So Tesla's going to be up another 7% this morning, as it now appears that Elon Musk tweeted out this morning that it appears that his $56 billion pay package will be approved. I need that job. I'd do it for I'd do it for $1 billion. I'll do it for a year for $1 billion. Yeah. Speaking of Tesla, of course, Tesla's in the Mag 7, and I don't know why they keep trotting Cathie Woods out on CNBC every other day to talk about her investments. ARK funds have just done miserably over the last few years, but she was talking this morning, raising her price target on Tesla. We'll see what happens, but it is a driver of the markets. And Mike, as I kind of talked about earlier in the show today, if you looked at the heat map of the market yesterday, it was pretty much bright green dots for Apple, Nvidia, Microsoft, Tesla, and pretty much everything else was either kind of mildly green or there was a lot of red on the heat map yesterday. So it certainly wasn't, despite the weaker inflation number, despite the conversation from the Fed, it was kind of back to the same old narrative of just a handful of stocks really driving the market yesterday.
Yeah, and it really seems like as the market keeps rallying here, the breadth is getting worse. So it's fewer and fewer stocks taking part. But again, what is it? 10 stocks or 30 plus more than 30% of the index. Mm-hmm. If those 10 stocks are doing well, it doesn't matter what anything else is doing. And that's what's going on. Like yesterday, even the market came off at the end of the day. The S&P came off towards the end of the day, but at its peak, it was up about 60 points, over 1%. And the Dow was flat to red all day. When we were I was looking at our own holdings. For a market that was up that much, it was surprising to see, quite a number of stocks that were basically going nowhere or slightly down.
Right.
And that's been going on. That's been going on. And it's really tough for investors because it's forcing investors, and it's circular too, because it forces investors to buy those 10 stocks, or it's not even 10 anymore. It's like 5 or 4.
Yeah.
Right. We were talking about the Magnificent 7. It's really the Fabulous 3, or on days it's only 1 or 2 of them. Right. Apple led the market all by itself 2 days ago. It was up 8%, and it's roughly 6% of the market. So right there, the S&P's up almost 0.5%. So it can offset hundreds of stocks that are down on the day.
Well, again, to your point, in today's daily market commentary, I have a couple of charts showing the negative divergence in the markets right now. The advanced decline line, the New York Stock Exchange advanced decline line, has been declining now for quite a few for the past few weeks while the market is rising. So that's a negative divergence. Relative strength has been declining while the market's rising. That's a negative divergence. And those things don't mean the market's going to crash, but it does suggest that probably you're going to, and the number of stocks that are trading above their 50-day moving average are declining as well. So you're getting, to your point, getting less and less participation in the markets. It's becoming more concentrated. But the problem is to your point, is that it's a circular problem, because as those stocks rally, a lot of hedge fund managers don't own those weights, right? So they may own 5% of Apple versus 7% of Apple or 8% of Apple, whatever its weight is in the index. So they've got to buy those to get performance. They've got to buy those stocks. So you're getting this concentration of flows into these stocks just from people performance chasing, and they're becoming much bigger weights in people's portfolios in order to generate that performance. Because everybody's trying to, hey, if you want to beat the index, you got to own those 10, those 3, 4, 5, 7 stocks. They better be in your portfolio, and they better be pretty heavily weighted
which is okay as long as everything's going up. You know, the big problem is at some point, someday, those are going to reverse, and you're going to have a correction of some sort. And it doesn't mean a crash, but you know, it wouldn't be outside the realm of normality for Apple to be down 20% or Nvidia be down 20-25%, especially after the run it's had. Having a fairly significant correction would not be, A, it would be healthy, but B, it would not be out of the realm of normality. But it would do a lot of damage to people's portfolios.
Right. I mean, Apple at its peak, at its high point yesterday, was up 15% over the last 2 days.
Right.
So when you talk about dropping 20%, it's basically gone. You know, if that were to happen, it's kind of a round trip. And we're talking days for 15%,
right.
not months or right. years, which is more typical. The other thing which you led off with earlier are buybacks. Buybacks are a huge deal. And, you know, when we look at Apple, what happened? Why was Apple up? What was it, up 7% 2 days ago?
Right.
And yesterday at its high, it was up 7 or 8% as well. What happened? Well, they announced that, you know, they formally announced that they're doing much more with AI, and they call it Apple Intelligence. So, you know, great marketing move. But a lot of what they said was known already by the markets. You know, they're getting more involved. They're doing all the right things. But it was known, and the day they announced it all, Apple was down on the day. And then the next day, suddenly it's up 7%. You know, there's who knows why, but there's rumors around that they were buying back a ton of their stock to make it look like AI is a great thing for Apple. Is it? We'll find out.
Right.
Was it Apple buying its own stock that pushed it up? Who knows? We're not going to know.
Right.
But it's just something to keep in mind that those companies with the most cash and the ability to borrow are the ones and are making good profits are the ones that can buy back shares. And that leaves a lot of other stocks unable to buy back their own shares. And it just, again, it's circular. The more they buy back, the more everyone else has to buy it, and the higher weighting they get in the indices, and it just circles and circles, you know, and it will break. But right now, that's the market we're in, and that's the market we have to invest in.
Yeah, I know, and that's the big conundrum, right? Is like what causes it ultimately to reverse? You know, we didn't see it in 2022. You know, in 2022. The market was down 25%, you know, 25% at its peak. You know, we had a decent correction in 2022. It would have been down a whole lot more because if you looked at a lot of the other stocks in the index, they were down 40, 50, 60, 70, 80, 90%. I mean, we saw some stocks like Roku and Peloton and others just get absolutely decimated during 2022. So it was those big market cap weighted stocks that really kind of held the whole index up because they never declined that much. So the question always becomes is what would it take to eventually get hedge funds to start selling Apple, Nvidia, Microsoft, Google, Amazon, Tesla? What's it going to take to get them to start liquidating those shares, which in turn would then cause individual investors to start dumping ETFs, which would then force further liquidations. And see, that's the big risk, is that whole passive indexing monkey that's sitting out there, because investors just buy ETFs now. They don't do a lot of individual stock picking anymore. So they buy the ETFs. That just funnels money into those top 10 stocks because those are the biggest weightings in those indexes. So the question becomes, what causes ultimately that reversal of flows into those assets? I don't have the answer for that, but you know, we didn't see it in 2022, which I thought was, you know, if there was ever going to be a good case for one, it would have been 2022. It just didn't happen.
I mean, it's likely it will happen. What causes it? Why it happens? Is it just one or two stocks that get really hit, or is it the top 20 that have moderate losses? You know, we have elections, we have wars, we have the economy. Could it be one of those? Absolutely. But it at the end of the day, it's a change in mindset and behaviors. And right now, there's not much sign that investors' mindsets are changing, that the mindset around buybacks is changing. You know, maybe if Trump wins, he says buybacks are going to be taxed now, or we're not going to allow buybacks, which did happen after the Great Depression. So something like that could be a trigger. But, right now, people are just guessing. And we're not, look, Lance and I aren't the only ones that know this. A lot of people know it. And that's what could feed an avalanche of selling. But for now, it's certainly not happening. And it's hard to see something on the horizon other than legislation or a big change in the economy that could really affect it to a large degree.
Yeah. Another credit event of some sort. I don't know what would cause whatever would cause a credit crisis of some sort, in the bond market would certainly happen. But yeah, I mean, but to your point, I mean, I talked about this earlier this week, as, what our jobs are is that we've got to make money for our clients, and we have to do that regardless of, what we think the long-term view is. And we talked earlier this week about having these big macro views and betting on macro views because things change and those views will change. But, because we're measured on a year-over-year basis, we've got to make money for our clients. And so we're forced to hold these stocks, whether we like them or not. We've got to own Apple and Microsoft and Nvidia and Google. It doesn't matter whether we agree with these companies or like them. If we don't own them, our performance would be so far behind the index, we would lose all of our clients. So, it's a very interesting challenge that we're put into in the current environment. And a lot of this has been fueled. Look, we've had over a decade now of just zero interest rates, artificial liquidity, buybacks to massive proportions, unlike we've ever seen, at any other period in history, that have fueled these excess returns in markets and this concentration of breadth. And what changes it, like Mike and I said, we have no idea. All right, come back after the break. Talk a little bit about bonds and interest rates. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
It's back. Get ready for our next live chat edition of Candid Coffee with Richard Rosso and John Penn, Saturday, June 29th. Anything you want to know, we'll find the answer.
What's going to happen to interest rates?
Should I put all my money in gold?
Has Lance been working out?
Register now and submit your probing questions for John and Rich at realinvestmentadvice.com.
How far will Nvidia go?
What about Social Security?
Who does Mike Leibowitz's hair?
The live chat edition of Candid Coffee with Rosso and Penn. Register at realinvestmentadvice.com. Realinvestmentadvice.com.
Are those your pajamas?
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So there's a whole big food discussion going on in our chat channel right now. And Brent just weighed in saying can't beat a hot chocolate chip cookie from Chick-fil-A.
Amen, brother.
I disagree.
Oh?
I disagree. I agree with Iconoclast, which says that challenge you to Slotsky's, because at Slotsky's, not only can you get a chocolate chip cookie, you can also get a hot cinnamon roll.
That's like apples and oranges.
That is not apples and oranges.
It's cookies and buns.
They have cookies too, which
I
are
know.
as good as Chick-fil-A's, if not better. But I'm telling you.
Well, Cinnabon is in a category all by itself.
Well, yeah, but you could take a Cinnabon and put it between two chocolate chip cookies.
Yeah, well, you can take a Cinnabon and...
Iconoclast, I agree with you. Slotsky's all day long. No
We'll have
problem.
to do some research after the show.
I agree. Research it is. And we'll report back to you on the show next week. Okay. A little bit about interest rates and bonds. Of course, this is the big question. Yesterday, not surprisingly, it was actually kind of an interesting week for interest rates. Going back to really kind of Friday, Monday, we saw pretty big declines in interest rates. They had been rallying very nicely, and then we saw bond prices. Rates had gone up. Rates have been coming down. They took a little sharp pop higher over a couple of day period, and there was kind of just positioning going into this Fed meeting. Then we had a Treasury auction. Correct me if I'm wrong, Mike, but on Tuesday we had a 10-year Treasury auction that was stellar. Had a record stop through on the Treasury auction. Rates dropped pretty markedly on that auction. Then, of course, yesterday with the cooler CPI, rates had dropped very sharply early in the morning. Bond prices were up 2.5%. They did pull back a bit towards the end of the day after the Fed projections were released, which only showed one rate cut versus two for this year. But again, that's potentially going to change. But it looks like now we're starting to kind of get, if you take a look at interest rates as a function, we're starting to get a period of higher highs and lower lows, and we're starting to build a much more bullish trend in rates going lower for right now. But Mike, what's your outlook on? Let's talk treasuries first, but I do want to get into corporates, and I do want to talk a little bit about private credit, because you and I had a discussion about private credit with one of our clients this week. But let's start with treasuries. Kind of what's your takeaway right now?
Yeah, no, I agree. We kind of broke in that downward channel in prices, and they're starting to move higher. And it's the economic news it's not really a technical thing, although it is, and we follow it closely, but it's the macro or the economic environment that's helping yields fall as well, right? We had an unemployment number that was very good at a headline level, but very bad when you dig into it. CPI was below expectations. We've seen a lot of weakness in the consumer sector. In fact, we're seeing a lot of big brands, Walmart, Target, Starbucks, McDonald's, Burger King. Someone else came out yesterday saying that they're lowering prices because consumers just are not spending as much. So what they're all trying to tell you through these special meal deal type things and through especially their earnings and revenues is that the consumer is really slowing down, and the bond market is starting to pick up on that. And look, at the end of the day, Powell said that their rate expectation is 2.8 now from 2.6. The problem is that 10-year bonds yield 4.25 to 4.5, and typically they are, over the last 20 years, they've been on top of inflation. So there's still a big premium between yields and current inflation rates. And if inflation rates come down further, which we expect them to, the Fed expects them to, just about most economists expect them to, that gap is even wider. So there's still plenty of room for the downside in yields, even if we don't go into a recession. If we go into a recession, all bets are off on how far they can go. So I remain very bullish on bonds here. And I think we're finally kind of getting that economic support that helps, along with technical support, to make the case a little better than it may have been 2 or 3 months ago.
So, yeah, and again, we talked a little bit about bonds on Wednesday with Danny too. And plus, you're right now you're getting, paid nicely, 4.5% just to, right, sit on a bond and hold it. The upside capital appreciation on that is, completely fine. But it's interesting. I'm getting a couple of comments in our chat section and talking about gold prices. One of the things that gold responds to, or usually responds to, is real rates. There's been a bit of a dichotomy between that as of late. But what's your take there?
So we did some analysis on this a while back, and what we found is that there's no correlation between gold and real rates when real rates are high. When real rates are low, there's a very high correlation. So when the Fed really starts cutting rates, and I don't mean a token 25 or 225s, but if they start really cutting rates back down to 2% to 1%, gold will probably do well at that point. But until then, I feel like gold is kind of caught in this speculative fever. Bitcoin, Nvidia, GameStop, but they're all different versions of the same speculation. And gold and copper, there's cocoa, orange juice. There are certainly fundamental underpinnings for all of those. And I've heard a lot of cases for gold, and some of them are legitimate. But at the end of the day, I think that speculation is driving the price of gold, both up and down. I mean, it's been incredibly volatile, jumping around $20-$30 a day. And some days, it's down 50 or 60 or up 40 or 50, 60. So, be careful in gold. For us, we'll get that sign to buy gold when it really appears the Fed is going to start really cutting rates. But the Fed's not there yet.
Yeah. So, interesting, we had this conversation with one of our clients this week talking about private credit. And private credits has been around forever. Private credit is basically a non-bank entity or a non-bank, structure that is loaning money to somebody else. But what's been interesting over the course of the last really 5 years has been this rise of private credit that's now falling into the realm of buy now, pay later, those type of things as well. It's a very opaque. Particularly buy now, pay later is a very opaque measure. They don't release their borrower details, so credit rating agencies really don't have a feel for what the risk is in buy now, pay later type debt. That's about $700 billion of debt that's out there right now. Again, that's small, right? That's, when we were talking about the subprime crisis, we were talking about $1.5 to $2 trillion worth of subprime debt. So, $700 billion, it's not huge, but it's certainly significant enough to sting a bit if something goes wrong, economically speaking. But, we're starting to see more people wanting to push into the private credit markets, take on kind of these, basically in a reach for yield is really what it comes down to. What do you think there?
I think you just said it well, the reach for yield. They're trying to get additional yield. And look, we see it in private credit. We see it in investment grade corporate bonds. They're trading at incredibly tight levels to U.S. Treasuries, at in many cases, record levels. So that means that you're not getting paid. Historically, you're getting paid a very low premium to take on risk. So, if you're buying a BBB investment grade bond and only getting paid 40 basis points more than a treasury, is 40 basis points, less than 0.5%, worth the risk of a potential default, but not even necessarily default. The company doesn't do as well. They get downgraded. The bonds prices go down because they want investors demand a higher premium. So there's a temporary decent loss on your books because the credit has changed. So, the question when you're lending money is always, what's the risk? And am I getting paid appropriately for that risk? And right now, across all the credit markets, the answer is there's more risk than I think the market appreciates, and there's less premium. And I know that because the premiums are very low. So you're not getting paid to take the risk. If we're not going into a recession, then buying a BBB bond at 0.5% more than a treasury, assuming the company does okay, is probably a good bet. But we go into recessions. Recessions happen, and they usually happen when no one thinks they're going to happen.
Which we now have that case, right? By the way, the economists now are pretty unanimous that no recession is going to happen. So maybe now we can have the recession.
Right. Right. So, like all these forms of credit are trading, at very high valuations. Think of them like very high PEs on a stock. And look, certainly a stock with a high PE like Nvidia can do very well because they're growing like crazy. But in the bond market, there isn't this growth that can offset that valuation, and the risk is ever present. And I would think, I would say the risk of a recession is growing just because it's been a while since we've had a recession. And all the stimulus is leaving the economy. So, the point is understand how much you're getting paid, understand the risk is more than the market is paying you for. Yeah. And if you're comfortable with that, that's great.
Next week, Mike, we need to touch on China and gold. A lot of conversation in the chat today right now about China replacing the dollar as a reserve currency, which is not the case. And I can't believe we're going to have to do this again, but we'll go through this whole discussion next week about why that is a false narrative, continues to be a false narrative, and will forever be probably a false narrative about de-dollarization. So we'll get into that next week, Mike. All right, have a great day. Get by the website, realinvestmentadvice.com. Mike's latest article, which is actually the featured article on Talk Markets this morning as well, is really a good read for you. So go by the website, realinvestmentadvice.com, and we'll see you back here next week.